Stop chasing Nvidia at all-time highs. And stop stressing over Supermicro's accounting headlines. If you are serious about finding the next asymmetric opportunity in the AI infrastructure trade, you need to look at a company that Wall Street is completely mispricing right now. This is a company that has just completed a massive identity shift, transforming from a cyclical memory manufacturer known as Smart Global Holdings into a pure-play AI infrastructure builder, now called Penguin Solutions, ticker symbol PENG. Why is this stock the most interesting setup in the market today? Because we are standing at a pivotal turnaround moment. The market still trades this stock like a boring memory commodity business, giving it a valuation that effectively assigns zero value to its high-margin AI potential. But the financial filings, specifically the fiscal year 2025 annual report and the just-released Q1 2026 10Q, tell a completely different story. They tell a story of a company that has stopped the bleeding, swung to profitability, and is positioning itself for the next wave of enterprise AI adoption. To understand where we are going, we have to look at the ugly past we just left behind. In fiscal year 2024, this company was effectively broken. The narrative was dead. They posted a significant net loss and investors fled. But fiscal year 2025 was the year of the pivot. According to their 10K, total net sales for FY25 climbed to $1.37 billion, up roughly 17% from $1.17 billion in 2024. That is double-digit top-line growth in a transition year. But the real story, the one the algorithms are missing, is on the bottom line. They swung from a massive net loss in 2024 to a net income of approximately $28.8 million in 2025. This is the textbook definition of a turnaround. They didn't just grow sales, they fixed their cost structure and proved they can make money while transitioning the entire business model toward AI. They stopped the cash burn, which is the most critical step in any turnaround thesis. Now, let's fast forward to the most recent. Data: the Q1 fiscal 2026 earnings ending November 2025. This is where investors are getting confused, and this confusion is your opportunity. Total net sales came in at $343.1 million, up just 1% year over year. On the surface, that looks flat. It looks boring. It looks like the growth has stalled. But you have to peel back the layers. First, look at the integrated memory segment. It exploded, growing 41% year over year to $136.5 million. This legacy business is providing the critical cash flow, fuel for their AI transformation. It's the cash cow that funds the future. Now let's address the bear case. The advanced computing segment, the AI part, actually fell 15% year over year to $151.5 million. This scares people. But here is the context the headline numbers miss. AI infrastructure revenue is incredibly lumpy. It comes in massive multi-million-dollar contracts. One delayed shipment shifts revenue from Q1 to Q2. When you zoom out to the full year of 2025, the advanced computing segment actually grew 17% annually. The long-term trend is intact. Why should you bet on PENG over others? It comes down to their specific niche. They aren't just selling commodity servers like Dell or HP, they are building AI factories. In the earnings call, management highlighted a critical shift in the market, moving from hyperscalers like Meta and Google to enterprise. Big corporations cannot build AI data centers by themselves. They need a partner to design, build, and manage the clusters. That is what Penguin does. They have managed over 89,000 GPUs and have a backlog that supports future growth. Furthermore, look at the margins. Their gross margin held steady at around 30%. This proves they have pricing power. They aren't engaging in a race to the bottom price war just to boost revenue. They are maintaining profitability, which is rare in a high-growth sector. Currently, Penguin Solutions has a market cap hovering around $1 billion. Think about that for a second. You are buying a profitable company with $1.37 billion in revenue, growing double digits annually, heavily exposed to the AI megatrend for less than 1x price to sales. If they simply execute on their existing backlog and the advanced computing segment returns to quarterly growth as projected, the multiple expansion could be significant. The risk is execution. They must smooth out the lumpiness in revenue and prove they can win consistently against larger competitors. But the financials show the turnaround is real. The losses are gone. The profits are here. The name has changed. It is time for the valuation to catch up.